Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, it's an often discussed fact how there are so many mutual funds in India and it's a difficult choice for investors out there. However, there's actually an even more difficult decision to make: when to sell your mutual fund and which fund to sell. And to discuss that, we have with us our in-house expert Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Dhirendra, to begin with, first up, with all your experience, can you please tell us what are the reasons that usually prompt investors to sell their investments?
Anything can prompt an investor to sell. Sometimes the market goes down and somebody's investment is doing very well, that can prompt him to sell. Market goes up and he has nothing else to do. He thinks that because market has gone up, so he must sell. Otherwise, market will crash and then he will lose all this opportunity. Sometimes people get bored. They invest, nothing happens, it goes up a little bit, comes down a little bit, and then somebody thinks that nothing is happening, so he must sell. So everybody is actually looking for some hyperactivity in the market. And that's why with their funds. And if it does not happen, then many a times I come across people that the lock-in period of my ELSS is over. Is it good time to sell or should I sell? If you tell them that, if you need the money, sell. They really think that they have to do it because, and there is a reason to it. People have been putting their money in a bank and then they started investing in markets or market-linked things. And market-linked things always came with a term. Like if you moved your money from bank, then you went for a deposit. You went for a deposit which has a start date and an end date, which means that you had to do something at the end date. Renew it or take the money out. Likewise for bonds, likewise for, you got an IPO, allotment, go and sell, get the money. So people thought that investment, you need to do something. Now in the design of an open-end fund, it's like your investment account. You put your money and you keep putting more and it keeps compounding, and it takes really, somebody to understand that, okay, this is my investment account. My investment is accumulating. You have entrusted your money to a fund manager and he's doing the needful. He's moving the money from the expensive stock to the cheaper stock, hopefully. Or, he's buying something which is cheap, selling something which is too expensive. And you don't need to do anything. And in fact, in the whole process, it's very tax efficient. So people think that they have to act and you don't need to.
Okay, so these reasons that you listed just now, do you think these are justifiable enough for one to sell their investments, or one can just be watchful and avoid selling?
These are reasons which an uninitiated investor, a relatively new investor, will be tempted to act because of all these preconceived understanding of the markets. And these are absolutely, no reasons for anybody to act. Forget about selling. If you follow these reasons, this is a recipe for disaster, because long-term investing and long-term investing in equity through a mutual fund by way of SIP is an act of discipline. You don't necessarily get rewarded for choosing a mutual fund or choosing equity, but you get rewarded for your disciplined investment into it. In fact, many times people come to me and they think that I know some secret. And if I tell them this fund is to be, you start investing, then he should invest because I have recommended, so it will work. And it does not really work like that. It works because market goes up in the long run. And in the short run, it is unpredictable. That's why you have to think of long term. Overcome the short-term temptations, believe in the long-term. It's an act of belief, if many people, they really don't see their investments through a full market cycle ever.
Okay, now, amid the recent market fluctuations and the regulatory changes that came into effect, when is the right time to sell a fund? Because there was, chaos among investors, they were hyperventilating, and so what do you think should be the reason to sell fund?
When to sell a fund, there are only 3 reasons, I'll tell you. And there could be variations of the reason, but the reasons are primarily fundamentally rooted in 3 of these things. One is that you invest for a goal. So you plan to invest and you want to buy a car, and tentatively you thought that in 3 years' time you'll do it. In 2 years' time, the money has appreciated, you have been lucky with the market, take your money out, and that is a reason, good enough reason to sell. However, earlier than planned. So meeting a goal, take your money out. And the other reason is that you invested with a time frame in mind, that okay, you are investing for your uh, retirement or for child's education. But before that, something more important came. So if your plan changes, then you might have to change your investment. People's circumstances. When you are investing, when you are accumulating, your circumstances, or you lose your job, or the context changes. So if your goal changes, then you can make those changes. That is a good enough reason to sell and make the corresponding changes. You liked the investment, you liked the fund for the long term, and you liked it, but after you bought, it has lost its likable feature. The fund manager is gone. It has stopped doing well. It has stopped doing well for a reason that it is, you are not hopeful that it will revive, or you're giving up, or you're losing patience. That's a good enough. You like the investment, it's no longer one. But no other reason. There is no external reason. Just because something happened in America, just because global financial crisis happened, just because a war happened, or just because the market misbehaved, because market volatility and all is matter of routine. There isn't a single day when the market does not fluctuate. Markets by its very design is, and also the regulations. The regulatory framework for investment, whether it changes dramatically or which changes incrementally or which changes nominally, but the pace of change is continuous. You don't have, whether it be in the context of stock market or in context of mutual fund, the operating framework, everything. So those are not good enough reason. Basically, it's a long bet on our economy, long bet on our company, and that is a bet worth, it's worth betting on.
Okay, and at times if a business is under scrutiny for some reason, that's also another pointer that it triggers the sell decision in investors. So is that a good enough decision?
That is one of the reasons, as I was saying, that you liked a fund, you liked a company. And the company, actually, you start discovering after you have made the investment that it's not as good, it is misbehaving, it is not doing the job well. That is a good enough reason. But then verify it. Many a times, a good company can also land into a very noisy mess, which may not be true. Sometimes it can get a lot of bad press, which may not be true. So it takes time, and don't act in a huff, because you have to pay the short-term gains. You have to pay the long-term gains. Acting in a hurry, redeeming your investment, selling your investment, there is a tax to be paid. Tax to be paid besides your, you take your money out, whatever be the gain, if it is short term or long term, 10% or 15% gets reduced. Then you have the added challenge of reinvesting it. The money could be idle in between, and you might be missing. Big problem is that many a times we take the money out, we think we will invest, and then we sleep over it for a while, and then we start think in terms of tinkering with the timing to invest. The timing instinct actually gets triggered. So get off this. Stick to a plan and ignore everything that is not significant. Yes, and you have to build in all the shock absorbers in your equity portfolio, in your mutual fund portfolio. If you're investing in a mutual fund, make sure that it's not, if it is a sizable amount, if it's a meaningful amount, make sure that it's not more than 25%. If you're investing in stock, make sure that nothing is more than 5-7%. So you will have 15-20 of them. And something goes down the tube, it goes wrong. It goes, it does not work out, it fails. It turns out to be a complete, disaster. Still, it will be 5%. You will still have the game going on for you, and you will not be left in the lurch.
Okay, so now Mr. Joshi has sent in a question. He says the rates of interest on deposits are not likely to go up any further. So is it a good idea to shift existing deposits to mutual funds?
I would like to give a framework to Mr. Joshi. One is that, interest rate is not likely to go up, not likely to go down, or likely to go down. It's very difficult. I have found that, last 4 or 5 years, whenever I have tried to guess it, I've been wrong. I've seen many fund managers going wrong. But, assuming that his hypothesis is right, still, he should not think in terms of because interest rates will go up or interest rates will go down, he should invest or not invest in a mutual fund or a bank deposit for a variety of reasons. One is that invest your long-term money into equity. Don't invest your short-term money into equity ever. So it is deposit or mutual fund or equity mutual fund is not a matter of this or that. It is guided by not by interest rate, not by state of market, but your needs. The money that you need in next 2-3 years must be in deposit, must be in debt fund. Because even debt fund, the character of that will be that of a deposit. Equity should be of a different kind. So be guided by your goal, and don't invest the money that you need in the near term, or the money that has to be in fixed income for overall stability of your portfolio. Like assuming that you have a lot of money which can be invested in equity, which you are unlikely to need for next 5, 7, 10 years. Still, I would suggest that never invest 100% of your money after your accumulation, not while you are starting your 5,000 rupee, 10,000 rupee SIP, but after it has accumulated meaningfully. Then make sure that you are able to build those shock absorbers so that you have 20%, 25%, 30% into fixed income. One, you can rebalance, that will be profitable. Second is that your overall portfolio will not collapse, because many a times in anybody's lifespan, 20, 25, 30 years of investing, there will be 2-3 occasions when the market will go down so dramatically that it will be your test of nerve. It'll it'll go down by 50%, 60%, 40%, and most of the time the market crashes or market decline or fall happens very dramatically, and all the gains, everything is very steady, so steadily rising. So that could be quite unnerving, even for a very seasoned investor, even for an investor who has been investing for 5 years, 10 years, and who has not experienced it, which I feel will be the case for most new investors. Anybody who has come in the market doing his SIP 5-7 years, and large number of them, if they are faced with a decline like we witnessed in January or March 2020, lot more people will actually go to sell and look for cover.
Okay, so Mr. Joshi, hope that answers your query. That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.